First thing is you realize that holding cash and dead assets is a bad thing. So a lot of money is in cash because people think that cash is the safest investment, but they are measuring that in amount of money that they get, nominal returns, and they say it doesn't wiggle much. But think about it. It's lost, as of the most recent statistics, 8.5% over the last, inflation is 8.5%, and they receive virtually no interest rate in cash. And so there was an 8.5% loss of buying power as a result of inflation. And so psychology should change and is in the process of changing to realize that you have to think in terms of buying power, not the number of dollars you have. And you have to think how much is your buying power. And so the worst thing is to be in cash. Like I say, cash is trash, and to be and to be out of the bonds.
I care about secular trends. Secular cycles, when you get them and capture them in the right point of the business cycle, become explosive. Remember that chart of the NASDAQ, the beach ball underwater exploding above the water because the Fed just took the foot off the gas pedal, or the brake, sorry? That's the power of a secular trend. It outperforms any other trend, and it's more calibrated to financial conditions. It's more juiced by the business cycle than anything else. These are the things that matter to me. And there's two massive secular trends that dwarf all others. Crypto.
But moving from the nominal bonds, in which the government just says, I'll give you this amount of money, and it has the unbelievable and unlimited ability to print the money it gives you, it would favor inflation index bonds. And it can be other assets. Some people would say something in terms of cryptocurrencies, or it might be those other assets. I think that too much people pay too much attention to one at the extreme of the other, that either somebody's all crypto, or they're all gold, or they're all something. And I believe that that's a challenge. I think that crypto, like gold, is not a productivity earning asset, and it can be controlled by governments in lots of ways. It's been outlawed in a number of places, and it also can be monitored. The privacy element is not secure from governments doing monitoring, and the size of crypto is about the size of Microsoft. It's all crypto combined. And so to be overly concentrated in it, in my opinion, is a mistake. But to have some of it is a good thing. So the question is always what amount of it. So that's I have a little bit about it. I'd probably shock you about how little I have. You would shock me about how much you have. But having some of it. So and other things I would say is that geographic location is important. In other words, not just all in US and US dollar assets. I would say that the three things that again I'm looking at if I go down countries is, first, are they earning more than they're spending? Do they have a good income statement and balance sheet? This is going to be very important in the period ahead, because the amount of credit that's going to be available to bridge the gap between spending and earning, cash flows and so on, is going to be quite narrower. So a lot of companies even that were able to raise cash and not have good cash flow because of maybe growth expectations in the future will find it more difficult. That'll be true for individuals. It'll be true for countries. So does it have a good income statement and balance sheet will be important. The second is places. How are they working with each other? Is there civility, or is there civil war, on the brink of civil war? Because countries where they work well together, they're productive, are going to have a real competitive advantage. Orderly places. There are parts in the United States that are better than other parts of the United States. For example, we just had the shooting in New York City on the subway, and New York City's becoming more dangerous. Chicago's becoming more dangerous. San Francisco's becoming more dangerous. You're seeing people leave some places for other places. You're seeing them leave, to Texas as Austin, or to Florida, and so on. So people do leave, and they do that, those who leave are higher income and higher taxpayers. And as a result, there's more of a hollowing out that takes place in that, which creates an economic problem as well as a lifestyle problem. So I think you're going to see greater differentiation in places, which affects where you want to be and where people who can afford to be there want to be, and also affects what their economies and markets are like. And that's so then the United States. And the third element is, are they financially strong? In other words, income more than expenses and good balance sheet. Are they civil with each other? So they're working together rather than hurting each other. And number three is, are they in a position where they're likely to be in a war, or are they likely to be out of a war? You don't want to be in a war. So, and those places, investing wise, history has shown, do worse because they have to spend more money. There's more problems, more pain that's being exchanged. Neutral countries in wars do very well, as it turns out. So elements of diversification. So it's a long-winded answer to your question, but I would not want to be in debt or cash and those instruments. I would want to diversify well with a bias toward inflation-protected assets. And I would want to diversify between locations, countries, in terms of the investment based on the criteria I've just mentioned.
Here's the chart, the long-term chart of Bitcoin since 2013. Some people use this chart longer term. I used to. But the early cycle was so kind of ridiculous that it screws up the chart. Other than that, it's actually a perfect log trend. These cycles can be crazy, and this one feels more like the 16-17 cycle than it does the prior cycle. And that cycle didn't have a lot of central bank printing. Well, not in the US, but central bank balance sheets were rising. We saw 20% growth, and what happened of liquidity, and what happened was crypto absolutely exploded. I kind of feel like that's the case. I don't focus on the end target. I focus on the structure. But I'm just showing you the magnitude of the opportunity. And we're still at one standard deviation oversold. It's all to play for. We've barely started. NASDAQ, another beautiful logarithmic trend. I mean, this is a killer. That's all you need to know. Is the world going to be more digital tomorrow than it is today? Yes. Will it be more digital in 2 years' time than it is today? Yes. Will technology reach more adoption in the coming 2 years? Yes or no? Yes. I ran that poll on Twitter. 95% of people agree with me. Yet most people keep missing this trend. They don't want to believe it. It's expensive. I think it's a bubble. Blah, 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 blah. Meanwhile, best fucking trend you've ever seen. So just capture the trend. It suggests the NASDAQ somewhere between 25 and 30,000 at the end of this cycle. That's another great set of returns. So those are the two mega trends. How do they compare? Well, simply put, going back to 1990, kind of the dawn of the internet and computing ages, the NASDAQ has just relentlessly outperformed. All of the noise you see on Twitter, mean reverting, the NASDAQ's expensive, blah, 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 blah. It is the biggest trend you've ever been given. And many of us in macro land didn't see this. We kept fighting it because of what happened in 2000. The bubble and bust. But that, as you can see, was extraordinary. The rest, super smooth. It's the same log trend. And I don't see that changing. Could we create another bubble based on AI and the exponential age? Sure. Let's make some bloody money from it, as George Soros would say. But I don't see any elements of a bubble. It's just a normal trend that eats all other equity sectors alive. There is no point owning other stocks. Every other bet is suboptimal in this world where everything is correlated.